What's going on, everybody? Good evening. Good evening, Rodrigo. We're going to get this one going in just a couple of minutes. Just going to give everybody a chance to hop on in. What's up, Dolly? Good to see you. Husky, welcome. Good to see y'all. Welcome in, welcome in. We got back-to-back lectures. It's been a while since I've done that. How's everybody feeling today? Hopefully a good day so far. NVIDIA is looking pretty interesting. We talked about this inside day yesterday, and it's still just getting tighter and tighter. It's got a nice look to it. Swung NVIDIA calls. Yeah, I can't say I hate that, especially after another inside day. Al Brooks likes Meta. Yep. Meta gave us what we were looking for there. That tightening up didn't make it all the way back down to the EMAs. All right, just gonna give it 1 or 2 more minutes before we get going, and then we will get this one started. You said Disney's looking good. Take a look. What's Disney got going on? Yeah, looking decent. All right, just 1 more minute here, and we'll get going. All right, a couple minutes after the hour. Let's get this one going. Welcome in, everybody. What's up, Norbin? Good to see you. What's up, Mike? Welcome in, everybody. Those of you who don't know me, go by the name of Tostie. Tonight, we're going to be talking about EMAs. It's a lecture, definitely not the first time it's been given here, but hopefully we can present it in a little bit of a different way, talk about the power of using short-term EMAs. Going to start by just introducing kind of the big idea of what we're looking at here. As you can see, tonight's going to be mostly a chart-focused lecture similar to last night, so I don't have any PowerPoint prepared. It's really going to be all about the charts tonight. And starting off, we have a decent example here looking at NVIDIA. And what we have here is an indicator that doesn't really look like 2 moving averages, but it is. And what we have here is 2 EMAs, the 10 and 20 EMAs. And in my opinion, these are the most powerful trend following or short-term trend following EMAs. Very similar to the 9 and 21. I mean, pretty much no difference. But the 10 and 20 is what I like to stick with these days. So big idea, kind of goal for this lecture is to introduce how these EMAs work, why they matter, and how they can be used to understand the short-term trend and where the more kind of fruitful risk to reward trades lie. So that's the big idea today. Starting off, though, I'm going to take it all the way kind of back to the basics here and talk about the differences of EMAs versus normal moving averages, kind of show some individual comparisons there, and then push forward and talk a little bit more about trading strategy. So that's the big idea of this lecture. Yeah, let's not waste any more time and get right into it. Starting off, we're looking at Thinkorswim here. So if you have any questions on kind of how to get this all set up in Thinkorswim, feel free to go ahead and ask. First thing I'm going to do is go ahead and throw down a simple moving average. And the way this simple moving average works is it essentially takes the last X amount of data points and divides it by the number of data points. And what I mean by that is you can see at the top here, the way this moving averages is configured is it's looking at the close of the last 10 days. So all it's doing is averaging the close price of the last 10 candles and dividing it by 10, and boom, that's where your simple 10 simple moving averages. If I go ahead and change this length here to, I don't even know if I can do 1, but it should just directly follow price. Yeah, so if I make it 1, it just directly follows price, right? Because all it's doing is just taking today's close and dividing it by 1, which is today's close. If I make it something like 2, it's going to follow price very closely, right? Because it's just looking at today's and yesterday's close. And if I change it to something a little bit longer, like 200, especially on a name like NVIDIA, which has been trending so strongly, it's pretty far below the current price, right? As you can see, the last average of the last 200 closes is about 85 bucks, as opposed to our current price, which is about 128.50. So that's really the basics of our simple moving average. And it really is a simple average, right? It takes the last X number of data points and divides it by N, which is the number of data points. So again, just a simple average. Comparing that though to the exponential moving average, you'll notice a pretty interesting difference right off the bat. So if I go ahead and pull up the 200 exponential moving average and make that red, you'll notice a little bit, let me make it a bit easier to see there. Like that, yeah. Okay, so you'll notice that this 200 simple moving average doesn't quite move the same way that 200 simple moving average does. And even if we zoom out to something like the weekly, you can see that they're both 200 period moving averages, but one of them is much closer to current price than the other. And the reason behind that is pretty much why the exponential moving average is more applicable in different ways than the simple moving average. The exponential moving average is a bit more of a complex calculation than the simple moving average. And what I mean by that is, as we discussed earlier, the simple moving average is, not to be redundant, but incredibly simple, right? It is 10 periods or whatever the length is, divided by whatever number of data points you have. The exponential moving average is calculated based on a formula that I don't know off the top of my head. But the most important thing to understand about it is the exponential moving average gives more weight to recent price action. And that's illustrated pretty clearly here, where the red line is the exponential moving average and the blue line is the simple. And you can see over the last 3 years, pretty consistently, the EMA is closer to current price. And this might be a bit more clear if we pull up a shorter period EMA versus a shorter period SMA. So if you look at the 10 EMA and the 10 SMA, which I'll pull up now, and probably zoom into something like the daily. Generally, the EMA is a bit closer to the current price, which in this specific example, it's actually not as clear. So I might even zoom into something like the hourly. Wow, that's interesting. It's actually pretty close for the 10 period. Let me zoom out a little bit because it's not as clearly illustrating what I want to here. Let's do like the 50 or let's do this one. Try that. Okay, so still reasonably close, but a little bit more of a gap here. And as you can see, for the most part, right, when price is moving higher, the EMA is closer to current price. When price is moving lower, the EMA is still closer to the current price. So like, for example, here we're in a downtrend. For the whole downtrend, that EMA is closer to the current price. Once we swap to an uptrend, this red line, the EMA, is still closer to the current price. And essentially what that means is that the EMA, or exponential moving average, is giving more weight or more significance to recent price action. And again, I don't know exactly the formula behind the weighting, but it's some factor where, you know, today's price action is more important than 10 days ago, as it relates to how this EMA is calculated. And that's really the fundamental difference between how the EMA is calculated versus how SMAs are calculated. You guys have any questions or comments on that before we move on? In the meantime, I'll set up the next example here. Nick says no. Okay. Why does it matter? Oh, Aaron, you're getting ahead of us here. So the reason it matters and the reason that this is a class on short-term EMAs is because as a shorter-term trader, these EMAs should be more important to you as they're more reactive to the current trend. And you may know this, you may not know this, but moving averages can be a great method for determining and kind of using as a confluent piece of analysis for determining the short-term trend. And we'll talk about that as we continue throughout this lecture and develop a couple of examples. But the short answer to your question, why does it matter, is the EMAs are a bit more useful as it relates to short-term price action. And when I talk about short-term, I'm really talking about 10 to 30 days on the daily. 6, I don't think that's exactly the same. I don't exactly understand what you're saying, though. Is it the same concept as the 5-minute and 1-minute charts? Not quite, right? The 5-minute exactly represents what's going on the 1-minute. It's just, it just doesn't have as much detail, right? Whereas the EMA isn't exactly the same as the SMA, right? They're fundamentally different. All right. Like it would, oh yeah. Yes, it would apply. Yeah, so this concept does apply to all time frames. Yes. So the EMA is calculated based off of the price action that you're looking at on whatever time frame that might be. So if you're looking at the 1-minute or the 5-minute or the 10-minute or the 1 hour or the 1 week, the EMA is always going to be calculated the same. It's just the data that it's using is different. So these concepts that we talk about within this class are going to apply to all time frames, to all charts. Hopefully that answers your question. All right. So moving on, a really common way to use these EMAs is to have one shorter period EMA, which I'm going to pull up the 10 EMA and make it nice and clear in blue. And then a bit longer period EMA, which I'm going to pull up the 20 EMA and make it red so it's easy to see. All right. Generally speaking, the way these two EMAs are used and the way kind of moving averages can be interpreted in general is that a bull trend is defined as when all the moving averages are stacked in order. And that specific sentence was a bit vague, but what I mean by that is, let's say, for example, I'll just swap out to another chart really quick because I don't want to get rid of this. Give me 1 sec. Let's say, for example, we're looking at some more traditional moving averages, right? Some examples of traditional moving averages would be something like our 20, 50, and 200-day moving averages. In this example, our 20 moving average is in yellow, our 50 moving average is in orange, and our 200 is in red. For a given equity to be in what's called a full bull trend, you would want to see the 20 moving average in yellow above the 50 moving average in orange, which is also above the 200 moving average in red. That would be defined as when price is in a full bull trend. And the reason that this is statistically significant data, and I've gone back to this backtest that I've ran in multiple lectures, so I probably won't do it tonight. But this specific signal right here, with the 20 crossing over the 50 on the weekly time frame, that's over the 1 or 200 moving average, has happened on the SPY about 4 times in the last 25 years. And every single time this signal has happened, the average return from this specific signal was about 140-ish%, I believe. And also, if you only trade the market long when you get this signal here and stop out when all these moving averages cross below the 200, you actually outperform the market over the last 30 years on the S&P. So, and since I'm talking about this, I might as well just pull it up. So give me a second really quick, just to kind of show you why this sort of thing matters. Where can I find that? This is going to take me a second, so give me 1 moment. Okay, I think I got it. Okay, let me open this up. So essentially the way that I ran this was if the 20 SMA on the weekly is greater than the 50 SMA on the weekly, get long. And if the 20 SMA goes below the 50 and the 20 goes below the 200, meaning that we're in a full bear trend, cut or take profit. And as you can see, the blue line here is that specific back test. The green line here was the S&P 500. And over the period that I ran this, which was 30 years, actually, not 25, the average return was 107%. Every single trade was a winning trade, so there was no losses as a result of the strategy. And the net profit on this was 1,100%, whereas the S&P returned about 800% during this time frame. So point of this being, moving averages can be incredibly significant, and monitoring the crosses above and below and the trend of the moving averages is it's a very strong kind of strategy. And the program that I use at this time, this was when I had a subscription to TrendSpider. I didn't really like it that much, but I thought this was one of the cooler things I ever did in that program, honestly. I'm sure that you can run these back tests in other sorts of programs, though I doubt it's just this. So that was a long-winded way of saying that these crosses in the moving averages are significant, right? And that was just something in the simple moving averages, right? So that's simple moving averages on the weekly, which is something that's going to happen much less frequently than EMAs on the daily, right? Short-term EMAs. So back to the short-term EMA example, right? Price is typically regarded as being in a bull trend when the 10 EMA in blue is above or greater than the 20 EMA in red. And generally speaking, it is more favorable to be long when these EMAs are trending positively, right? It's just easier. And NVIDIA's a little bit of a tough example because, I mean, this thing's really been moving higher for the past year at this point, almost 2 years. So I want to pull something up that's been a bit more difficult to trade, which is probably like a name like PayPal. And PayPal, you can kind of see how this has worked out, right? Generally speaking, once these, and PayPal's been a name that's really effectively been in a range. If we look at the weekly, it's done absolutely nothing, right? The moving averages are pretty much flat. It's gone nowhere over the past multiple weeks, or sorry, years. When zooming in on the daily, though, the picture becomes a bit more clear. If we highlight every single place where these moving averages crossed, here, barely there, 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 and there. Working away from the left side of the chart to the front. On the left side here, we have the 10 EMA below that 20 EMA. And you can see pretty much every rejection of that 10 EMA or every movement of that 10 EMA was a short, right? It was an opportunity to get short. And conversely, right, when the 10 EMA was trading above the 20 EMA, every dip into the moving averages was an opportunity to get long, right? For the most part, right? Obviously, there's going to be times when this fails, like around this area, right? Not perfect, and it never will be. But it's a very good initial frame of reference in order to look for these trades with the trend, right? I mean, you can look at this on any asset, and this is a pretty terrible name to trade over the past 3 years, right? It's in a range on the weekly, and you don't want to get too excited about a trend trade if a name is in the range on the higher time frames. But you can see pretty clearly, for the most part, right, these two crosses here are less significant, but for the most part, every cross of these moving average has resulted in multiple fruitful trades in that direction of the trend. Most recently being this cross to the upside here, dips to the moving averages were buying opportunities. And this is a pattern that is repeated on many different equities across the marketplace, right? We look at something like Shop, same sort of pattern, right? Where here, generally speaking, right? I know we talked about the Shop idea yesterday. I had other reasons to buy down here, but for the most part, right, we did get at least one short opportunity on that first tag of the moving averages before we started to reclaim them. And on the first reclaim of these moving averages, right, the next dips down into them were long opportunities, right? These moving averages cross to the downside. After this moving average cross to the downside, we got, let's see, how much downside after that, right? So moving averages cross to the downside, stock price dropped 25%, right? Moving averages cross to the upside here, stock price has now increased by about 10%. So these moving average crosses can be a bit of a lagging indicator. However, it's a really important way to confirm the direction of a trend. And me personally, I'm the type of person that's looking for trades that are a bit easier, right? I'm not looking to fight the trend. I'm not looking to catch the bottom, right? I'm looking to take advantage of dips when price is in an established trend, right? Because generally speaking, that's always going to be easier to do. And I'm not looking to be a hero. I'm looking to find the easy money in the market and take advantage of it. And the EMAs, specifically the short-term EMAs, can be a very nice and clean tool to identify those sorts of opportunities. I'm going to take a quick break here. Does anybody have any questions, comments so far? How are we feeling? I don't anticipate that this is all brand new to everybody, but maybe presented in a different way this time around. What are our thoughts so far? All right. Huskies got the thumbs up. 6 is feeling good. iPhone's bullish on the shop gap fill. Which one? Yeah, I guess it just finished that gap fill up. Pretty crazy. Could you repeat one more time? Yeah, so the EMAs that I typically follow are the 10 and 20 EMAs. And the reason that I do that is because a trader that I like to follow, his name is Oliver Kell, came up with or wrote a book on his trading strategy that I read almost, I don't know, maybe like 9 months ago now. And I really enjoyed the way that he presented the concepts in that book. And I was already using the 9 and 21 EMAs, but I never really had any specific reasoning or backing behind that. I just kind of knew that other traders use them. Tilio used them, but I never really saw any like logic necessarily behind it. So I read through this book, really liked it, and ultimately just decided to switch to 10 and 20 EMA. But again, right, the difference is very, very minuscule. Like if we run a comparison really quick and try and pull that up, we'll just pull up the 9 EMA and compare it to the 10. Make our 9 EMA yellow here. So this is our yellow line versus the blue line. There's pretty much no difference. I mean, they follow each other very, very closely. Like Aaron said, the difference right now is 50 cents on shop. I mean, that's a rounding error on most trades, right? A name's trading about 50 cents is 1% in the stock price, which we always talk about. The market's more of an art than a science. And if you have a key level, the best way to trade off of it is probably just squint, because there's a chance it's going to get undercut or overran or whatever it might be. So it's much easier to just kind of be a bit more loose with how you're looking at it. All right. We can take a look at VRM. Yeah, I guess we'll just look at it. This isn't necessarily a charting lecture, but we might as well just see if it's a decent example. So honestly, not a great example, in my opinion here. Yeah, I mean, this one's just been through way too many reverse splits. It looks like, 1 to 80 reverse split. Oh, double R. I thought that was a typo. BRRM. Wow, I have never heard of this. So let's just check this out really quick. Let's remove the 9. So right now, based on this moving average strategy, this is not the place to be getting long, right? We're in declining moving averages. Now, if for some reason we're bullish on this name, which, maybe I could see a reason why. I think this candle is pretty ridiculous. We've kind of been holding that top end of the range there. If you're bullish, me personally, this is a name that I would definitely be more patient on. I would probably be waiting for the 10 to get back above the 20 and probably a retest or break above this 28 level. And strictly because why not be patient, right? Why not wait for the easy money once this trend turns positive, right? I mean, you can look and see at the reaction in price every single time that's happened, right? Notice here, I mean, this is a random company. Every single time that moving average cross happens, for the most part, there's a sustained move in that direction, right? And obviously that move eventually fades just like anything, but that's part of the game, right? No indicator, no signal alone is going to be perfect. So the point of this lecture isn't me just saying every time the 10 is over the 20, get long, right? And we'll talk a little bit more about specific places where an entry makes more sense and where it makes a bit less sense. But in general, right, it really helps provide a framework, or at least a set of rules where you tell yourself, if price is trading above a positively trending set of moving average, I look long. If price is trading below a negatively trending set of moving averages, I look short, right? I mean, it's a pretty simple framework, right? It's really something that you don't need to overcomplicate. And again, as I mentioned, right, it's not something to be used just on its own. Just like any other indicator, just like any other piece of a strategy, right? There should be multiple reasons you're considering to get in or out of a trade. Six has a question. So when across you're looking to swing a call for a few weeks out. Yeah, I think that's generally a reasonable way to think about this. Obviously, we're looking at the daily time frame here. This isn't something where we should be considering, a weekly contract necessarily. I mean, while it could work, we have to be thinking like swing traders here. And typically speaking, if you're trading on the daily time frame or daily setup, you really shouldn't have less than 2 weeks time. So in my opinion, yeah, that looks like maybe potentially a monthly contract, even a 2-month contract, because why not have that kind of safety net? Because once you get that crossover in the moving average, that price is moving in your direction at this point. And typically speaking, you'd probably want to have a stop loss at the previous swing low. So for example, and I guess getting into trading strategy a little bit on this random name, let's talk a little bit about how I would have traded some of these. I guess here, right? Here we have this, and this kind of ties back into what we discussed yesterday, right? Here we have this big extension lower on high volume. Then here we have all this volume coming in suspiciously above the moving averages. Right about here is when the moving averages flip positive. So 2 ways to trade this, right? On the day the moving averages flip positive, you technically could get long, right? Generally though, what I would probably be doing here is the best way to really trade this is set a stop at the previous swing low, which that's down here. So that's, let's see, about a 10% decline, or no, about 7% decline. So it's a pretty significant kind of gap there. So I would really want to be a bit more cautious when structuring a trade like that. And I would probably want to wait for a touch of the moving averages, which in this case would be right around here. And even this specific example, I probably would have wanted to stop out on a close below prior day's low, which would have meant that I would have stopped out here. So just being transparent here, I'm not going to act like, oh, you would have just got long right here and held the whole way. Like, no, I mean, and then that's not realistic, right? Odds are, if you were taking a trade on that first tag of the moving averages here, it would have been very reasonable to take a stop out on the next day as price closes below. However, if you're being open-minded and you see us reclaim this level the next few days, it's also incredibly reasonable to say, okay, I was probably a little bit early to this trade, but it's still incredibly valid. And based on the moving averages, we're in an uptrend, right? So there's a couple ways to trade it. If I stopped out on this, I probably would wait for either a break of this swing high or this one, which either one ended up being completely tradable. And then sell points, right, is just pretty much support and resistance, right? So finding your key levels from the past. So that would have been one way to trade this. And again, with full transparency, right? 2 ways to trade it here. You could have taken a trade long on this one, and I don't really know why I'm continuing to look at this weird stock, but it's a decent example. Anyway, 2 ways to trade it, right? The first day the moving averages cross, you could certainly go for that long, but you have to be mindful that you might not be entering at the best point. There's not really any specific setup at this point as well. And as a result, you really should have a pretty wide stop, at least down to the swing low, which is about $1 per share decline, which actually is a bit closer to 7 or 8%. That's on equity. So if you're trading options on this one, that would hurt really bad if you had to have a stop like that. But it's really the most logical stop in this case. But if you did take a trade like this, right, you have to remember that if you have a stop that's wide, your profit target should be that wide and then some, right? So typically 1.5 at minimum risk to reward, which would have brought you right around here, which actually would have worked out. But anyway, that's a little bit too much detail for the moment. That said, that's the kind of big idea and kind of first discussion on entries. Again, this is another great example, right? You get this pretty ugly looking move down. Certainly could have tried shorting it on that first tag of the moving averages, which showed profits, right? One reason that I would suggest not taking that sort of trade, though, is because the trend is still positive overall. We're still setting higher lows and lower highs, and that's just another reason to be mindful of the moving averages aren't everything, right? If you're looking to go short on this tag of the moving averages, if you look back and zoom out, price is still in an uptrend. So you have to be mindful of that, right? Although the short-term moving averages have switched to the downside, price is still trending upwards. So anyway, those are some first couple examples on this VRRM. How are we kind of generally feeling about that? I think we definitely have a little bit more to talk about, but first steps there. We got one question from Juan. He says, "Is it a good indicator for scalps?" Yeah, absolutely. It's definitely a super valid way to be day trading. And just to kind of show you that, let's just take a look at the S&P from today. Here's all the price action from today being Wednesday. You notice we open up and all day, right? This is the 10 and 20 EMA, just presented in more of a cloud format, which I'll talk a little bit about. The cloud is green, meaning the 10 EMA is above the 20 EMA. And you'll notice, right, for the most part, all morning, longs for the trade to be in. You can see we come down and retest the moving averages here, right down to our open price area, and that area ultimately holds. We come back down, moving averages still trending positively, even at this time, although we're below it. We come back down to our prior close, hold that area, long still remaining the favorable trade. Here would be an example of a short that didn't quite work. This actually looks pretty decent for a short, if I'm being honest here. We break prior day's lows on high volume, then come back up and retest the moving averages on declining volume. That's definitely would have been a nice short to try, but certainly didn't work this time around. But once moving averages flip positive again, really the rest of the day is just dominated by a trend higher. And overall in the market, a bit of a slower day, right? You have to be mindful that the EMAs are really kind of most powerful when trading with the trend. It can certainly be helpful as a scalper in a range as well, but their real power is shown when price is trending. Alex says, any insight on when you take an entry off of a touch of an EMA versus a close over? Yeah, so it's an interesting question. It really comes down to the type of trade that you're trying to take. So the reason that I say that is because if you're a scalper, right, you got to be taking those entries at the touch of the EMAs, right? So here, for example, is where you take those longs, right? You're not waiting for anything except to tag that EMA, and you want to see that hold. As a swing trader, or maybe a day trader, you might be able to wait a bit longer. So, for example, you might be able to wait for a touch of the EMAs and then also a bar with increasing buy volume off of that. So today, for example, it would be this bar here, right? That would be the first candle where we got some increasing buy volume off the EMAs. That would be an opportunity where maybe you could take a day trade based on that, right? Clearly buyers are present here. And at that point, you could go ahead and try something long, probably trying to target this area from previous highs, which ultimately didn't really make it all the way there. So I think the answer to your question is really, it comes down how you're looking to trade. Me personally, I'm not really very much of a scalper, so I'm less interested in those scalp type of trades. I don't know why I just started getting a phone call. Oops. Okay. Yeah. So me personally, I'm less of a scalper. So generally speaking, I'm more focused on waiting for that volume to come through or a nice reversal bar off of that level. Yeah, very interesting question, Albrecht. Albrecht says, how do you decide whether the base swings off of EMAs versus SMAs on the daily? Does it have to do with the time period of how long the trade will take? So me personally, I typically am not basing trades strictly off of either, right? Obviously, this class is directly about EMAs, but that doesn't mean that that's the only thing that I'm looking at on the higher timeframes. So that said, when looking at the higher timeframes, I like to see either those positively trending SMAs or those SMAs turning into levels of support. So one of the main things that I'm interested in on the higher timeframes actually is the 50 SMA. And we look at something like that on, let's say, PLTR probably is a decent name. So zooming out on the higher timeframes, looking at PLTR here, one of my favorite SMAs to look at on the higher timeframes is the 50 SMA. And the 50 SMA or 40 SMA is a really nice one for long-term trend direction. And generally speaking, when price trades above that 50 SMA on the weekly and that 50 SMA begins trending to the upside like it did right about here, the trend is essentially now confirmed to be in the upside direction. Outside of that, these levels are really just, once that's established, they're really just levels of support or resistance for me. So for example, on something like Amazon that recently came down to that daily 200, right? This is just an area to watch out for in terms of support or resistance. Same idea with, I think Microsoft revisited the same area, Google as well. I don't know if the Q's got all the way down. Yeah, so the Q's got all the way down there as well. So on the daily, right, that 200 level, 200 simple moving average, 50 simple moving average, I just treat those as areas of support and resistance. And mainly the 200 and the 50 simple moving average are the ones that I'm paying attention to. Roberto asks, the red-green bubble-looking thing is called an EMA cloud. Yeah, so essentially that's what it's referred to as. And just to kind of explain what we're actually looking at there, the EMA. Ooh, how was that? So again, as I mentioned, the EMA cloud just shows a combination of two EMAs. So for example, I can kind of change what this looks like. So right now it's set to the 10 exponential and 20 exponential. I can make this show the 10 and 200 exponential if I want, and it looks a little bit more like this, pretty disgusting. But the EMA cloud really just helps me visualize the trend of the EMAs. So the 10 EMA is on top, the 20 EMA is on the bottom here. So when the EMAs are trending positively, we get this nice green cloud. When they're trending negatively, we get this nice red cloud. And it's just an easy kind of quick look indicator for me to be able to look at a chart and determine what the short-term trend is without even really having to think about it, because the colors do all the work for me, right? I don't need to do much thinking. I can see exactly where each EMA is just based on that cloud. I know what the short-term trend is, and I can either move on or look into that given name a bit quicker. So for example, iPhone is asking for SPHQ. Right, very quickly you can identify that this is in an uptrend. The short-term EMAs are trending positively, and then you can start to move into actually kind of looking in. Oh yeah, do I have a link to share this? Yeah, let me share this really quick. Let me find where this is at. EMA cloud. Cool. So here's the link to that EMA cloud study. I showed this in last night's lecture. I'll show it again. In order to actually apply that, you have to go into setup, open shared item, and then just paste that URL that I put in chat here. And this is in Thinkorswim only, so this won't work for other brokerages. So you go ahead, put it in here, and then from there you can essentially just click import, and it's good to go. Cool. All right. So yeah, back to this example. iPhone mentioned that this is a pretty decent example of what we're illustrating, and yeah, I think I generally agree with you, iPhone. Looking at this specific chart, right? And I will say, like, most names are going to be a pretty good example of this, right? This is pretty universally applicable. As I can't stress this enough, though, it's not something that you can really just use alone. And this is something that I was mentioning a lot in last night's lecture. I'm looking for a retest of these moving averages for a lot of names, right? NVIDIA, if we come down to these moving averages, absolutely a long opportunity there. PLTR, same idea. Shop, same idea. Shop, SHOP. A retest of these moving averages definitely would be an opportunity to be getting long. Yeah. Yeah, Alex. So what I said earlier is that the EMAs are best for determining the short-term trend, and it's applicable to all time frames, but me personally, I typically am using it on the daily, 5 or 15 minute. And then the SMAs are better for looking into the long-term trend, because those are actually can end up being really key levels of resistance or support. That 200 simple moving average is going to be one of the most important moving averages. And you'll pretty much always see that level acting as some kind of support or resistance on any name that you trade. If you think about it, 200 days is, I think it's about the amount of trading days in a year, if I remember correctly. Let me just check really quick. If we look at the 1 year time frame, how many days is this? I think 200 days is about the number of days in the year for the market. It is 254. Okay, so the 250 moving average would be the average over the last year as it relates to trading days. But 200 still very, very commonly used, and important to a lot of different sorts of traders. Any reason in particular that people use the 9 instead of the 10? To be honest, I don't have any specific justification for that, Alex. It's certainly common. I'm assuming it's kind of just a legacy thing. Like somebody must have started using that. Some good trader must have kind of popularized that idea, and people have just kind of stuck with it. And as a result, it's continue to be significant. That's my best guess. Yeah, I don't have any information otherwise, though. I know Paleo uses the 9, River uses the 9. Yeah, I used to use the 9 a lot, and I have absolutely nothing against it. Yeah. Any other questions? Yeah, Roberto, that's an interesting question. Roberto says, have you ever used the EMA cloud indicator as an indication to be more bearish or to get short? And the answer is yes, right? It works both ways. However, like I mentioned earlier, you have to be mindful of not only the trend in the actual stock, but also the trend of the rest of the market, right? For example, if we look back at something like NVIDIA, while you certainly could have gotten short here on this cross to the downside, and it did work, it was super volatile. And still, right, zooming out on the higher time frames, it's still in an uptrend. And even looking at the structure of price on the daily, oops, that's 4 hour. Even looking at the structure of price on the daily, right, this is still technically an uptrend. We have higher highs and higher lows. This was the first lower high, but we never really got a lower low, right, a significant lower low. So just like anything, right, while the EMAs are very powerful, you have to also be able to zoom out and look left on a chart and figure out where you actually are in a trend. Like I mentioned, right? If you wanted to get short on this name, this would have been a perfect entry, right? This retest of these declining moving averages was effectively the top tick. I mean, right here, this is perfect, right? Nice rejection bar off the moving averages. They're now declining. This is, I mean, beautiful, right? Beautiful entry there, but not easy to catch. But the answer is yes, right? It works both ways. I know we highlighted the long side. I mean, the market's in an uptrend right now, so I'm going to continue to highlight the upside, uptrend on both the short term and the long term. So I'm going to highlight that. But yeah, it absolutely is possible. Right. Any good setups on CMG? Yeah, we'll take a look at CMG. So Chipotle, kind of similar idea of something that I would probably stray away from at the time, at the moment. Right, looking at the weekly trend, just flipped negative on the weekly, right? So the 10 EMA is now below the 20. So a reason for caution here. And then also again on the daily, right? The moving averages are trending negatively. Now we are starting to form some kind of base here with a lot of volume on this last day, which I'm assuming is probably when their CEO quit and went to Starbucks or something. But yeah, what I would do on Chipotle at least is I'd be patient, right? I'd wait for these moving averages to begin trending positively, but it does have some kind of early signs of potentially a base forming here, right? We have these really nice kind of double bottom with a whole lot of volume on that second day. It looks like it's really starting to try bottom out, but I'd have a bit more patience. And kind of similar idea with Starbucks, right? Which is a bit of the opposite. Here you can see big gap above the moving averages and starting to slow down a little bit. If we take a look at the weekly, right, that trend is just getting ready to flip positive after this nice basing formation. Me personally, right, I'd probably be looking for an entry if the moving averages catch up, right? So ideally we get an entry somewhere around the low of this bar and the moving averages catch up to that area. So we get this kind of consolidation that continues throughout a couple more days, ultimately come back down to this Newsday low, which was when they got a new CEO. And ideally right around this area is when their moving averages end up. You heard of someone use a super trend indicator. Yeah, I'm not sure what the super trend is, but this one's definitely pretty simple, right? There's not much to it. It's just two moving averages. So it's not like we're reinventing the wheel. It's just a little bit different of a way to present those MAs. What do I think of some swings on NVIDIA earnings? Honestly, I don't have much to say about it. Yeah, honestly, I don't have much to say in specific about NVIDIA earnings. That honestly, me personally, it's not something that I would really be trading at this point. At least through earnings, I'm just not really interested in it. I mean, if I had to guess, let's just take a quick look. Thank you. Let's see what they're looking for. Come on now. Oh, why isn't it loading? Well, anyway, this isn't loading, but I'm not super in tune with NVIDIA's fundamentals, so I'm not really in a position to say if I'd be interested either long or short in this name. Yeah, I think in general, right, the sympathies would be better opportunities, kind of like you mentioned, your AVGO, your AMD, your Marvels, your Dells. But to be honest with you, I'm really not in a position to say one way or another, which actually Marvell's looking rather interesting as well into its own earnings. I actually don't mind this. Looks pretty decent. ASTS. I heard somebody talking about that recently. Oh, wow. I wonder if Norman was on this one. Norman, you still in here? Did you catch this? Wow, that's nuts. I mean, what a trade there, right? EMA split positive, been a ripper ever since. I mean, look at that. Oh, it was you? I mean, check out how this has played out, right? Once you get that big move above the moving averages, it's been just an absolute ripper. Every touch of the moving average has been a buy. Literally every single time it comes back into the moving averages, it's been a buy. And I think that's another interesting point to highlight. The EMAs, at least the 10 and 20 EMAs, are pretty typically a very reasonable point to get long or short in a given name. It's always a very valid entry, right? If you know if you're trading off those EMAs, price isn't overextended at that point, at least in the short term. So yeah, definitely always somewhere to be thinking of taking entry if your other criteria that you're looking for are satisfied. We say Norton, VRRM, same. Okay. All right. Any other questions, comments? What are you guys thinking? Check out IVR's earnings report. They did just report, or IVR? Their most recent report? Let's see. Okay. They're losing money. They're losing way more than so the book or the street expect them to be profitable this quarter. They lost money. Paid out a dividend. Let's see. So they're blaming interest rates. They're valued. Oh, that's interesting. They're trading below book as they claim. They're saying they're worth in cash and related assets 921 and 959, which I'm assuming they hold a lot of property because they're a real estate investment trust. And that's not difficult to liquidate instantly. Let's just see. Huh. Yeah, I mean, it definitely not probably the most amazing place to put your money, but a reasonably safer investment, I would say. Lower kind of volatility. It's a REIT, right? So with those REITs or real estate investment trusts, you're really banking on kind of that dividend for the most part, which it doesn't really seem like this is the strongest name in the marketplace in terms of dividend. But let's just take a look at something else like O. O is a bit more expensive, but price action is much stronger, at least in the short term, which is not different. It's not an Invesco REIT. I think it's a private or different company. Anyway, yeah, interesting report. Not something I'm super in the loop on, but allegedly they're trading below book, which would be a positive if long. I mean, their book value is declining, so that must be either their assets are valued lower or they're selling off assets, which either one isn't the most amazing thing ever. Anyway, yeah, we'll look at Airbnb, and that'll probably be what wraps it up for the night. A, B, and B. Let's see. All right, Airbnb is a textbook example of something that I am not interested in really at all right now. On all time frames, right? At least the higher time frames, weekly and daily, moving averages are trending to the downside. Could it retrace up to this 121, maybe even 125 area? Yeah, maybe. It's just not something I'm interested in taking. Why would I try and get long on a name looking like this when I can get a name that's trending positively at a nice area with a solid risk to reward with positively trending moving averages? Yeah, not something I'm super interested in right now. Yeah, especially after a reaction like this to their earnings report. Clearly, investors were surprised in a way that didn't excite them, which is never a positive sign. So, not something I'm interested in. Yeah, personally. All right, everybody. I think that's going to do it. Yeah, if anything, Aaron, interested in a short, but I still think on this one, it probably needs a bit more time. I mean, this thing is down almost, let's see, 40%, it looks like, in a couple months. Yeah, 35%, 30%. Yeah, definitely not looking the worst for a short. I would probably wait for this little trend here to crack, something like that, which I guess it kind of already has. Yeah, not something I'm very interested at this point. All right, everybody. Well, that's going to do it for us tonight. Yeah, appreciate you guys all coming out. As always, if you have any, when I finish, can I check my DMs and look at your settings for the EMA? Yes, Aaron, I will do that right now. Are you trying to set this up on TradingView? Why? So that looks fine. You're just setting up the 9, which is fine. So yeah, that looks fine. And also, Aaron, just as a note, those EMA Cloud things are also on TradingView. So there's those studies for EMA Cloud as well. And if you're not paying for TradingView, that'll help you out because then you could have multiple EMAs with just one study. Because on TradingView free, you're limited to, I think, 3 indicators last I used it. So if you actually use the cloud, you'd actually save a bit of space there if you're looking to use more. Cool. All right, everybody. That's going to do it for us tonight. As always, appreciate you guys being here. And I will see you all in the next one. Adios, everybody. Have a good night.